Welcome back. Futures are indicating a fractional move this morning at the start of trading. We are looking ahead to a big week of earnings and economic data, so investors are cautious going into this week. The big banks are kicking off third quarter earnings season this Thursday. Joining me right now is Penn Mutual Asset Management Portfolio Manager George Cipolloni. George, great to see you. Thanks very much for being here. What are you expecting from the third quarter reporting season? We'll finally get a look at what profits are doing in the face of this inflation.
Sure. Thanks for having me this morning, Maria. So earnings season. So we already really, Maria, are in an earnings recession. If you exclude energy, the much maligned energy sector, that's really been lifting the total average earnings estimates for quite some time now. Last quarter, if you exclude energy, earnings growth was negative. Next quarter, looking at earnings, it looks like it will be negative 4% if you exclude energy. So energy is really doing a lot of the heavy lifting here. And we've heard from a lot of companies already, as you know. We've heard from FedEx, we've heard from Nike, we've heard from AMD. And the picture is not that pretty at this point. So it's going to be a challenging quarter looking forward.
Yeah, I mean, that's what investors have been anticipating. We had a 600-point sell-off on Friday. Market's down about 30% year to date on the NASDAQ, 20% on the Dow. We've also got key inflation this week. The producer price index is out on Wednesday, the consumer price index out on Thursday, and retail sales on Friday. That ahead of the Federal Reserve's meeting November 1st, where I guess we are still looking at 75 basis point hike expectations. What are you expecting from this data this week?
Yes. So I think what's important is that, look, the Fed is going to do whatever it takes. And that's what Jerome Powell said 6 months ago. And he's kind of stuck to that path. So what we're doing now is we are really resetting to a 4% hurdle rate for all investments. And that's creating a huge challenge across the board. We've seen what it's done to pension plans over in the UK, and that could have an impact here as well. But so the cost of capital is increasing. The ability for corporations so there was a huge tailwind for the past handful of years where companies, there was a net benefit to refi. That's gone now. So your cost of capital is way up. And again, I think the Fed is trapped by inflation, so they must maintain this course, at least for now, until inflation falters.
George, Adam Johnson, question for you. And by the way, good point on energy keeping up the rest of the S&P 500. But about 30% more companies than usual have already pre-announced earnings and said they're not going to be good. My question is that enough that expectations have been brought down so far that we're actually setting the stage for potentially not as bad as feared?
There is always the potential for that, Adam, and that's a great point. So the market doesn't always move as we expect. Sometimes it'll get way ahead of itself, and usually it does get way ahead of itself. I think the one point here, though, that's important, during the prior handful of recessions, the average earnings estimates have gone down about 13%. And we just aren't there yet. So I still think the market may be anchored to a slightly higher level of earnings than may come through. But to your point, it will be baked into. So Micron last week, when they reported a disappointing guidance, really didn't go down that much. And to your point, because a lot was already in it. So for investors, absolutely, expectation is one thing we need to gauge in addition to what actual earnings will be.
So how do you want to allocate capital here then, George? What are you expecting for year end, and how will that, impact specific sectors and stocks? What are you doing?
Sure. So everything we mentioned so far has been pretty negative. I think the one really good positive thing is that there is yield to get now because that hurdle rate's up to about 4%. And in corporations with strong balance sheets, you can get 5, 6, or 7%. So our focus right now are on net debt-free balance sheets, and they are out there. And companies that can generate positive free cash flow through the cycle, run by management teams that have been good capital allocators in the past. And so that really is where the bulk of our fund is. And like I said, we're going to get some really good yield for that now. So the risk reward has definitely shifted in favor of yield investors today.
How much cash are you sitting on?
So not that much, but if you include our allocation to short duration bonds, bonds that will mature between now and the next few years, it is significant. It's probably closer to 30%.
Wow. George, it's good to have you this morning. Thanks very much.